Well, I think you're seeing signals from the various policymakers and the market reaction, really trying to figure out what is the paradigm moving forward. We are currently yo-yoing between the liquidity paradigm, which is very much here to stay now and for the foreseeable future. There is so much cash in the system that has to be put to work and needs to chase a yield. And this paradigm of, is there inflation? How much inflation? When? How long for? And when does the party stop? So what we have today is certainly a more range of a possible outcome set than we had 6 months ago, when it was all up for longer and no end in sight. So we now see certainly more of a bell curve of outcomes, and the market trying to find where the normal is between the various options presented to it. So we had some weird movements in the yield curve last week because of some of this mixed messaging, showed an inversion in the 2-year, 5-year versus the long-dated yield curve. So you're seeing these various gyrations across the medium because the market is trying to find this new normal set point given the mixed signaling from policymakers.
Sunaina, you point out some disparity in the private and public markets and how to tap into that. Just walk us through what you're witnessing, because it feels as though you've got hot markets, whether it's public or private at this point.
Well, you're absolutely right. Almost every market is hot. It's hard to think about where does deep value really lie. However, one thing we have seen over the last 12 months consistently is the fact that on a relative basis, private markets look better priced. How do you get to that conclusion? Well, if you look at IPOs, whenever they happen, you see this incredible pop in the price almost immediately and sustained price increases, meaning that the private market valuation on a relative basis was lower than the public market ones. And you are also seeing that in this surge of M&A activity that's happening off of private books. So what that means is, how do you exploit that valuation differential? There are indeed ways to do that. There are permanent capital vehicles that are listed in various stock exchanges, mostly in London, of the large private equity funds, Apax, 3i, and so on. They often will trade at parity or at discounts to net asset value, making them an increasingly interesting buy and hold strategy and a diversifier to portfolios.
It's interesting, though, when you look at the retail investor at the moment, Sunaina, there is still a lot of excitement about getting into public markets at the moment. And Vanda Research had some data out on last Friday suggesting that US retail stock buying hit record levels, and they talk about a net inflow from individual investors in excess of $2 billion here. We know that they already own a lot of stock in the United States. Are you surprised that there is still an additional marginal buyer out there in the retail space?
I am not at all surprised because of the increased fiscal stimulus that's happened in the US government, the various stimulus checks that have landed in household savings accounts. Household savings rates are strong at the moment, and some of that cash is going into the stock market. That is to be expected. And I think that inflow is really driving what I'm calling a technical movement of most markets. You're seeing technicals really driving the trajectory of the markets rather than fundamentals. That will change. Those technical movements cannot last forever. You all know it from your many decades in the markets. I know it. But markets have very short-term memory, as you all know. So right now, everything looks incredibly hot and bubble-like in many spaces, for sure, and tech growth in particular. But it cannot and will not last. And the question is, how do you, as an individual portfolio holder or even as an institution, position yourself so that when the music does start to, perhaps the volume starts to go down, as we're starting to see in the markets over the last couple of months, how are you positioned so that you are hedged on the downside, as well as are able to take advantage of some of the upside from some of these technical flows that are very strong. You cannot predict when they stop, but you know that they're not going to be able to last forever.